Do you know why most people never become truly wealthy? It's not because they don't earn enough. It's because they don't give their money enough time to grow. What if I tell you that a simple shift in how you think about time could be the difference between struggling and building generational wealth? Hi everybody, today we will be discussing why long-term investing isn't just smart. It's the most powerful tool to secure your financial future. Let's start with the basics. What does long-term investing means? Staying invested in assets like stocks or mutual funds for 10, 15 or even 20 plus years. It's not about timing the market. It's about giving your investments enough time to grow. Think of it like planting a tree. You don't expect fruits in the first year, but with patience, care and time, the tree grows strong and rewards you with fruits for decades. The same principle applies to investing as well. In the short term, markets can be volatile. For example, during the COVID-19 pandemic in March 2020, the Sensex fell by almost 40%. Many people panicked and sold their investments. But by February 2021, the Sensex had not only recovered but hit record highs. This shows why patience and long-term view are essential for success in investing. Now let's talk about the real magic behind long-term investing. That is compounding. Compounding is when your money earns returns and those returns generate more returns. Over time, this creates exponential growth. Here is an example. Rupees 1 lakh invested at a 12% annual return grows to 3.1 lakhs in 10 years. In 20 years, it grows to 9.6 lakhs. But in 30 years, it becomes almost 30 lakhs. This is why starting early is so important. The longer you stay invested, the bigger your wealth grows. Warren Buffett, one of the richest investors in the world, credits compounding as the key to his success. Did you know that over 90% of Buffett's wealth was earned after his 50th birthday? That's the power of letting time and compounding do the work. India is one of the fastest growing economies in the world, and this growth is reflected in our stock markets. Over the past 20 years, the Indian stock market has delivered an average return of 15% per year. Why? Because of factors like young growing population, rapid urbanization, initiatives like Make in India and Digital India, which is driving economic growth. When you invest in the Indian market through mutual funds, index funds, or even blue chip stocks, you are essentially betting on the future growth of Indian economy. And historically, this bet has paid off. Now let's talk about short-term thinking. Many people believe that 3 or 5 years is long-term, but in investing, that's not enough. Over short periods, the stock market can be unpredictable. For example, between 2000 to 2010, the US S&P 500 index delivered almost zero returns. But between 2010 to 2020, the same index grew by over 250%. The Indian markets are no different. There will always be ups and downs in the short term. But if you stay invested for 10 or 15 or even 20 years, the returns tend to be even out and reward patient investors. Think about this. If you invest rupees 1 lakh and the market fell by 20%, you are left with rupees 80,000. But if you don't sell and the market recovers by 30%, your investment grows to rupees 1.04 lakhs. The key is not to panic and let time work in your favor. Now let's talk about how to start long-term investing. Starting your long-term investing journey is simpler than you think. Here is a step-by-step guide. First, choose the right investment option. If you are a beginner, start with index funds like Nifty 50. These funds invest in top 50 companies in India and are low cost. For higher returns, explore equity-oriented mutual funds or blue chip stocks. Second, use SIPs. SIPs allows you to invest a fixed amount every month. This helps you build wealth gradually and reduces the risk of market volatility. For example, a monthly SIP of Rs 5,000 at a 12% return can grow to 11.6 lakhs in 10 years, 50 lakhs in 20 years, and 1.76 crores in 30 years. Number third, stay consistent. Markets will rise and fall. It's normal. The important thing is to stay invested and not react emotionally in short-term fluctuations. Number fourth, diversify your portfolio. Don't put all your money in one stock or sector. Diversification reduces risk and ensures steady growth. Now let's talk about why patience and optimism matters. Investing isn't just about money, it's about your mindset. During tough times, it's easy to feel negative and think, what if the market crashes? But history shows us that every downturn is followed by a recovery. For example, after the 2008 financial crisis, Indian stock market dropped by over 50%. But within 2 years, it fully recovered and delivered massive gains to investors who stayed invested. The most important lesson we learn here is always bet on growth. Over the long term, markets reward optimism and patience. To sum it up, long-term investing is the most reliable way to grow your wealth. Start early, invest consistently, and stay patient. Remember, it's not about timing the market. It's about time in the market. If this video inspired you to start your investing journey, please give the video a like, share it with your friends, and subscribe to the channel for more actionable financial content. Together, let's build a future where you take the control of your financial well-being. Thank you so much for watching the video. Signing off, Samesh Rajpal.